Hi there, everybody.
Recording in progress.
Go ahead.
Hi there, everybody. My name is Sandra Edmond, Queen of Tax Thieves, and I'm so excited today. We have got an accounting professional who is excellent in all things related to real estate. We've got Juan Pardo, Pardo CPA. Juan, tell everybody a little bit about yourself, introduce yourself, and why everybody should listen to people like you.
Okay, thanks, Sandra. My name is Juan Pardo. I've been doing accounting for over 20 years and always related with the real estate environment. And my main goal out of everything that I've learned in the past is to basically revolutionize the way small business owners, especially real estate investors, view their financial report in order to make better decisions and know where their money is going at any given time. That's my goal. And I do this by applying accounting, taxes, and bookkeeping methods, et cetera, et cetera. And we're going to get a little bit more detail in a little bit. But that's my goal. The real estate investor to be able to enjoy reading a financial report made customized for them and make better decisions and grow.
I love that part. Make it enjoyable for investors to read the financial reports and agents as well, because sometimes we're not very good at that stuff. We like avoid the QuickBooks end of it. It gives a little bit of some of us some anxiety. How often do you think that investors or even real estate agents, people in real estate, should talk to their CPA?
Okay. I hear the terminology talk to their CPA all the time, right? So it looks like most people associate CPA with a guy that does the taxes at the end of the year. But in between, the most important part is the bookkeeping part. So you have to really keep your books very organized because if not, the CPA will not even know what to do with it, right? So the CPA, some CPAs do tax, right? And some don't, but I wouldn't talk to them less than maybe 4 times a year. And I say this because if you have a CPA that's gonna do your taxes February, March, April, etc., you want them to at least get together with your bookkeeper every quarter, at least every quarter, to find out if there's anything that needs to be tweaked or changed or have a proactive approach. If you see your CPA or the tax preparer once a year, and it's usually after the year is over, it's usually too late to make a lot of the changes and planning and tax planning. So the short answer, and feel free to stop me if I start because I get too much into the detail type of thing. I would say 4 times and have a CPA that is flexible enough to be open to talk not only with your bookkeeper. Real estate investors have coaches, have mentors, have mindset coaches, have real estate investment. There's a whole team. You need your CPA, your attorney, your coaches, and your bookkeeper to kind of at least talk once in a while about the benefit of the investor. Because if you talk to your bookkeeper one time and then you talk separately with your CPA at the end of the year, there's going to be some disconnect. Did that make any sense?
Yeah, that does make sense. So quarterly, speak with the CPA and involve parts of your team, like your bookkeeper.
Yep.
Think about involving the bookkeeper in that too. So it's probably better to work with a bookkeeper that already is working with your CPA, or maybe your CPA has a bookkeeper that's there already.
Both ways could work as long as the CPA is willing to communicate and be open about stuff. What happens with CPA, and we'll continue using the terminology CPA, but in reality is the tax preparer, right? They go by IRS accounts. They go by IRS rules. They analyze things based on IRS type of thing, which is great. That's the compliance part. If they're tax planners and they know about real estate, they also get involved with the planning, so they come up with ideas. That's why you need to see them more often than once a year. The bookkeeper is going to be the one that keeps your books on a monthly basis. So we can see that differently because we want your benefit. That's why I say I want to revolutionize the reporting type of thing. So when you read it, you understand what you're looking at. But then I need to be talking to the CPA or the tax preparer to make sure that they understand what we're doing so they don't come back and say, oh, why are all these accounts like this? There's a reason, because we need to analyze it. And
Mhm.
sometimes the two books are not going to, they're going to match at the end. They're just not going to match organizational wise for the CPA to know. That's why I said, if he's willing to understand how not every tax preparer or CPA is a real estate, which is another point. You need to get somebody that really understands the real estate investor. If you get a general taxpayer that does everything, there's going to be some stuff that you and I understand to analyze, that when they see it, they might not know where it's coming from. So definitely bookkeeper and CPA talk, communicate, and at the end of the day, it's the benefit of the investor. So we need to get along with one another. I'm always open to talk to any of my clients' teams. So I think I went on the tangent there. I don't know.
No, that's fine. Also, we talked about this on the phone. Is it important for an investor to have a bookkeeper?
Oh my God, it's more important than you would ever think, especially the real estate investors that do flipping. They spend so much money in coaches, mentors, marketing, cold callers, uh, I don't know, Facebook ads, clicks, text campaigns. They spend so much money in that. Then they spend a lot of time looking for the houses. They do all the work. And if they don't have a bookkeeper to organize their properties individually, they will not know how much money they're making or not until they sell the property. And I've seen it more often than I would like to admit, where when I analyze something once a year, they don't realize that they didn't make as much as they thought they did, or in some cases they even lost money. The thing with flippers is, or real estate flipping business, is that there's a lot of loans coming in, there's a lot of money putting in for the investments. So there's always money changing in the bank accounts. But if you don't organize it to the T, and later on or in the next video, I can show you the typical accounts that I use. If you don't organize it per property, it's going to be almost impossible for you to know which properties are making money or not. So the short answer is, like, I would not have a flipping business if I did not have a bookkeeper to organize my transactions.
Hmm. Because as investors, we think we're going to have time to be able to organize it. What ends up happening?
Yeah, that doesn't happen.
That doesn't happen.
No, and the most you're going to organize is probably in Excel, because like my son is a real estate investor. All day he's in Excel doing the comparables and the budgets and the MAO and all that stuff, and that's great. But the thing is great in paper. In the accounting software, is going to be real money. In Excel, is going to be numbers only. You type it, whatever you type is going to appear in Excel. In the accounting world, in the bank, is going to be real money. So if you don't compare what's really happening in your accounting world with what you projected to happen on your Excel or your budget world, you won't know until it's probably too late. Like the example that we were talking about before, if you have a 3-month period of rehab, and then in month one, the bookkeeper tells you, hey, Sandra, something's going on here. Your cash is almost at 100% rehab, and you still haven't put the roof, for example. Adjustments need to be made, because if not, it's going to be a very uncomfortable surprise at the end of the 3 months. You say, oh, wait a second, I didn't make the 50,000 that I wanted to make. I'm down
Hmm.
$10,000. And,
Hmm.
and we can go on and on about that, but the short answer is absolutely yes, especially for realtor flippers. Always have your bookkeepers, accountants, CPAs, whatever you want to call it, organize properties individually, always individually, so you can analyze property by property.
Yes, yes, absolutely. Really good. All right. So I had some of my investors, students that I work with, send in some questions as well. And we're going to go through what some of those questions are. I already started going through what some of them are. So one of them is, what business structure should I use for real estate investments and why?
Okay,
That's also a popular question.
that is the one of the number one questions I always get asked, but the answer is going to be generic. Okay, it's going to be a general answer, because one size doesn't fit all the time. Normally speaking, there's two types of incomes. There's the passive income and there's the ordinary income, or the active income. Normally, real estate rental properties could go ahead and open up LLCs and be taxed as partnerships or be taxed on your personal tax return, etc. Because rental properties only get taxed as passive income, meaning that they don't pay self-employment and all the other FICA expenses that we normally pay either when we're employees or when we invest actively on a business. So for rental real estate, it's okay to do LLCs. Normally, if it's two or more people, you can just go ahead and be taxed as a partnership. If you're the only owner and you open an LLC, you'll be taxed as a sole proprietorship. But tax-wise, it's okay because you're not going to be paying extra taxes on it. Now, for the wholesaling or real estate flips or anything, any business that you're going to be actively involved, I personally recommend opening an entity as an LLC, but then request to be taxed as an S corporation. And do you want me to go ahead? I can share my screen and tell you why, or do you just want me to give you the?
Yeah, if you have something you can share with us, yes, absolutely.
Yeah, so let me go ahead. I'm going to share my screen real quick, and you tell me, do you see an Excel spreadsheet here?
No, not
Oh,
yet. I
no,
still
not
see
yet.
you.
Hold on a second. Let me see.
Yes, now I see the spreadsheet.
Okay, so I'm going to try to make this as simple as possible so we can continue with the other questions. But for example, let me see. Here we have two entities, right? Let's say an LLC taxed as a regular sole proprietorship or even partnership. And here we have an LLC taxed as an S corp. Okay. So what happens is that every single dollar that you make from this company is going to be taxed with self-employment tax. Self-employment tax. Okay. This one here is going to, everything is going to be self-employment tax, of course, to a maximum, I don't know, 150 or $160,000 a year, and then the Social Security stops. But with the S corporation, the advantage is that you have the choice, right, to break down the income in two different buckets. One of them is going to be, let's say, the salary, right, and the other one is going to be the distributions. And the advantage is that whatever you take out on the distributions, you don't pay self-employment taxes. Let me make the X right here. You don't pay self-employment tax on the distribution. That's why when you operate a business, that's why S corporations are so popular, right? They give you the advantage to break down the income into two. One is going to be salary. Yes, self-employment tax. This distribution, no self-employment tax. Of course, you have to abide by some rules, reasonable compensation. You need to keep track of payroll, et cetera, et cetera. But if you're making 150, 200, $250,000 net income, you can save a lot of money with the S corporation. That's why, generally speaking, any business that you're going to be operating or involved in and is going to be considered ordinary income, I would go with an S corp. And then the rentals, I'm okay with leaving them as an LLC without the S corp election. Did did I lose you or are you still
Oh,
there?
no, that's a perfect way to explain it. So, question is, what if you have an S corp? You did not set up an LLC, but you have the S corp, period.
You can't.
Is that still good to do, break it into the two, or what is the
No,
benefit of doing the LLC tax as an S corp versus just an S corp?
well, the thing is that there's no such a thing. Entities are a LLC, C corp, and you can even open a partnership, etc. These are entities, right? Here is tax election. Okay, you can go S corp or C corp. Oh, sorry. Oh my God. My pen is not writing. Okay, C corp. So basically, in order to be an S corp, you need to be either an LLC or a C corp, and you can be elected to be a S corporation, or you can be an LLC and elect to be a C corp. But you can't just open an entity that is called an S corp. That doesn't exist. S corporation is not an entity; it's only a tax election.
Wow. You know what? I thought for all these years that I had an S corp.
Well, everybody calls it that because they're so used to saying S corp because everybody. So what do you have? An S corp, but in reality, you have an LLC. If you go to sunbiz.gov, right?
Uh-huh.
The oh my God,
Yeah, the
State
corporation.
Department,
Yeah. Hmm.
State Department, and you search for your company, you're gonna find out that you either have a LLC, a PA, a corp, but it's not gonna be an S corp because it doesn't exist.
All right, I'm gonna have to look it up and come back to you and ask you more about that.
Yeah,
So
no
you're
problem.
saying open the LLC and make it taxed as an S corp. No, I mean
If
when I look up mine, I might have additional questions then to say, well,
Yeah,
wait, what have I done?
yeah. Well, and remember, this is generally speaking because let me stop the share so you can see me. I don't know if you still see me when I share my screen, but
Yeah, we'll see you.
what happens is that remember this is general, right?
Hmm.
So, for example, if you're doing a flipping business and you do one flip a year, and with all the expenses you have through the year, your net income is, I don't know, $10,000 a year. Maybe the S corp is not right for you because you're going to end up paying somebody like me to do your personal tax return, your S corporation tax return, the bookkeeping and everything just to save a few $100s on taxes. Maybe that's not the right time. So if you want to throw something, because I can always answer questions, it depends, it depends, it depends, and then the audience is like, come on, man, just tell us what you think. That
Everybody's situation is different. No, I totally get that.
Yeah, but if you want to eyeball it, I would say between 50, 60, $70,000 net income after all the expenses, then it may be a good idea because you can save two, three, $4,000 a year in taxes.
To do the what?
The S
It's
corp.
an S corp. Okay.
Yes.
Taxed as a LLC or taxed as an S corp?
Well, when I say S corp, I'm only talking about the tax
The tax
connection.
implications.
Yeah.
Okay, okay.
Now,
I'm
you know
sorry.
what? Maybe I think I might have gone too fast on that one because I assume everybody knows what self-employment is. So, self-employment is the mixture of the Social Security and Medicare taxes. So, when you are an employee, let's say you work for a corporation and you get your pay stub, normally you you get deducted like 7.65% between Social Security and Medicare. But when you own your business, you get deducted that times two because you're the employer that pays 50% of it, and you're the employee that pays the other 15%. So when I say self-employment, and I'm sorry, I've done this so many times that I think that I automatically know that everybody understands that self-employment is about 15% that you pay. So when I say savings, when you're an S corporation, everything that you pay yourself as a distribution, you save about 15%. And I say about because there's some credits and it's not always perfect to 15%, but it's more or less 15%, which is a lot of money. 15% of $100,000 is $15,000.
Yeah, we want to save as much as we can, that's for
Yeah.
sure.
So that's that. But again, if it fits your needs, if you're not making that much, you don't want to save 15% of $10,000 to pay somebody else $1,500 to do your taxes and keep up with the payroll and keep up with the other technicalities of an S corporation. So everything has to be done for the client itself specifically, but it's impossible to answer that question for everybody at the same time. So generally speaking, rental properties is okay. LLCs as regular LLC sole proprietorship or regular LLCs as partnership. Flip and wholesaling, it's okay as LLC tax as S corporation when the right
Let me ask you this then too. What about if you are an investor and you are working surplus deals? So when a property goes to the tax deed sale, if the property goes to auction, if the property sells for in excess of the opening bid, there's a surplus that remains. And one of the techniques that we do is that we find the person that owns the surplus and we charge them a fee to help them fill out the paperwork. So we're making income based on that fee. So if that is the majority of your business, how should that entity be set up? And then also for real estate agents, what is the best entity for them?
Okay. For the first one, the surplus, I don't have any client that does surplus, but it's very interesting that the whole world of that industry is very interesting. I would say it would also be an S corp because you're going to be involved working on the business. It's not going to be like a rent. Imagine this way: when you invest in the stock market, you buy stocks, and then you continue doing your real estate investment. You forget about the stocks, right? And then
Mhm.
eventually you sell it. Those are capital gains. It's not ordinary income, so you don't pay self-employment taxes on that one either. Now, on rental, you buy the rental property, and then you go home and you still do your real estate investment and everything, but the property is making money. That's why it's passive. You're not
Passive, yes.
involved, right? Most other businesses are active. So if you're doing deals, you're making phone calls, you're trying to get the I don't know, the court to give you the documents so you can call the client and say, hey, you can get extra money if we do this paperwork and everything. I would say that's active, and you would do S corporation as well.
Okay.
And for the real estate agent, most of the time, S corporation is the way to go because they are actively working as a real estate agent. It's not passive. They are, they're involved on the business itself. Now, for real estate agents, just a side note, because I know a little bit about the rule of the real estate agent in Florida. Your company has to be called like Sandra Edmond LLC. Sandra Elmont, PA. Juan Pardo, LLC. It cannot be like Sandra, the queen of deeds, real estate agent,
Hmm.
because then remember that the license is based on the personal level, the real estate
The
agent
name,
license.
yes.
Now, the
Yeah.
broker could be called because it's a business, but the person itself, if they want to become a business, look into that before you open up any entities, or talk to your broker, or look at the statute of your real estate to find out if they allow you to have other names.
Yeah, that's very important. In Florida, they definitely have to have their name in the company as a real estate agent. Um,
Did I ask real estate agents S corp, right? I answered that.
yes, yes, you did. Next question, how can I maximize tax deductions related to my real estate investments? Did we touch on that? I think we.
Taxes is one of those things. Like in real estate rental, most of the time, if you ask a loan, if you have a loan for the rental, most of the time you should not pay taxes because there's a big deduction that you get, that is the depreciation expense. When you have a property that is residential, you have 27 and a half years to depreciate it, right? And that's not cash. That's just a deduction on tax. That's it. So it helps you. And if you have a mortgage that is charging you, I don't know, 6, 7, nowadays, I don't know, if 10%, you are already paying a lot of interest expense on that property. So more than likely, the typical case, you rent, you have all the expenses, you management fees and everything, then you have interest, and then when you add the depreciation, you should be at a very low amount of net income. So normally it's not that much, and if not, it's because you got a very 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 good deal, and then oops, sorry, and then you can go ahead and use that money to either invest in other places, or start a retirement, or or maybe open an S corporation to do management on other stuff, and you can pass through that income somewhere else. But
Hmm.
sorry, I'm trying to put the
No,
microphone. Can
it's
you
on
still
my
hear me?
end. Sorry, that's my.
Can you still hear me? Okay.
Yes, I can hear you just fine.
So rentals is that. On the other business, definitely, if you're doing real estate flips and you're making a lot of money, you need to have a plan to know what to do with that money, because you are going to be taxed on anything that is left over. And at that point, you can look into the typical things are retirement accounts and stuff like that. But you're still putting money. So it's not that you keep it and you put money and then you save on taxes on that. I personally like HSA. That's one of the ones that I like the most, because HSA is
And
the
tell them what that is. What does HSA stand for?
health savings account.
Hmm.
I really like that one. You have to qualify depending on what type of medical insurance or health insurance you have. But the advantage of that is that it's basically kind of like an IRA that
Hmm.
you can use for medical expenses in the year that you made a contribution. You don't have to wait until retirement age, or you don't have to wait until to get it out, because if not, you get penalized, etc. With an HSA, you can go up to like 6,000 and change dollars every year for family, and then you can use it. And who doesn't have medical expenses, at least a few times a year? And
Absolutely.
and you don't pay taxes, and you don't pay taxes when you use it for medical expenses. So it's kind of like a savings account that you deduct taxes when you contribute, but you don't pay taxes when you use it for medical stuff.
So how would they open an HSA account? Is that something the CPA would do for them? And
The
how far in
CP,
advance should they do it?
the CPA could guide, right?
Mhm.
But there's a lot
Or
of
the
H
accountant, as I should say,
or
right? The
an
accountant.
accountant. Like, let me see if I can't remember the name of mine. My wife takes care of that, to be honest.
Okay.
But I think it's called Further, Further. They changed the name Further. Um, there's different types of HSA companies, and it's like a
And
savings.
we'll include a link then for that company that you
Yeah,
mentioned in here as well for everybody. Hmm.
yeah, we can do that. I personally like that one a lot. Besides that, I would say, um, when it's a flip, besides the retirement one, uh, look for ways that you can go ahead and invest more. If you're making that much, just keep investing. I don't have a real answer. I know a lot of accountants say, like, if you're paying taxes and you're a real estate investor, you're doing something wrong. But I think they're mostly talking about rentals and passive, because you have much more tax leeway with passive and investment. When you're a flip, it's like having a business. So the same would apply for a real estate agent. The same would apply for you can depreciate when you have a flips. It's not and you know what? Maybe we should touch into
What
that.
are the deductions that a flipper can do then to maximize, tax deduction?
Everything. I
Hmm.
mean, the flipper is a business. For the IRS, a flipper is a dealer of properties. That's what it is. It's a dealer. Now, maybe I should back up a little bit, and because a lot of times people think, and correct me if I'm wrong, maybe the people that have worked with you have brought this up. They say, "Oh, I am buying a property, I'm selling it, and I'm getting capital gains." I heard that a lot before. They think that the flip business is an investment that you make capital gains, and that's not the case. I mean, if you do one every 5 years, maybe you can say, "Oh, you know what? I got it, then I decided to sell it." But if you do two or three a year, it becomes a pattern. So now it's not a once in a blue moon type of thing. So now you're an investor that buys houses with the intention of selling it. Is a business. And for the IRS, that's considered kind of like a dealer, and it doesn't go in your profit and loss, it goes in your balance sheet. So if in December, this is, of course, the example is going to be extreme. If in December you buy 5 properties, right? You spend $1 million buying 5 properties. You took out $1 million and you paid for them. You cannot get any deduction because you haven't sold them yet. They go on your balance sheet. They go on your, like, on hold. So you can't just say, "Oh, wait a second, I spent $1 million. Let me deduct it from all my other income that I made every other way, every other place." You leave it in the balance sheet. On January or February, then when you sell it, all those expenses that you had on your balance sheet on hold, they are transferred to the profit and loss or the income statement, and then you can deduct everything from the sales price. If not,
Uh,
you would have a negative $1 million on December, and then the next year you're going to have a $2 million profit without any expenses. So the expenses need to match the income on the year that it got sold.
so which is why it's important to have your QuickBooks or whatever software you're using track properties and the expenses related to these properties versus having just a generic category for marketing,
Correct.
generic
Correct.
category for, you know, supplies and things like that.
Yeah.
Because you're
Yeah.
not realizing the deduction yet, in essence,
Yes.
of the year that you sell it.
You
Really?
can't. Yeah. You can't. You want me to show you real quick? Is that
Yes,
something? And I know we're gonna do per chart of accounts in another moment, but I think it's worth the sharing if we're talking about it. This is a little bit of what I was showing you before. This is my balance sheet for a flipper. You see here?
please.
Okay, let's say property one. Let's say you bought ABC Maple Street, property one, and you purchased it for 100,000. You had some title expenses or cost, loan fees, etc., etc. All of this, right? It stays on the balance sheet, right? It's not an expense yet. It's an investment, or call it inventory. I don't know if that's the right terminology for the IRS, because there are some stuff that is not really inventory. But and then let's say a week later you start hiring your contractors, your material, buying your materials. Then you start paying the interest that you got from the hard money lender. I don't know, maybe there's some real estate tax due on that month. Property insurance, for sure, you need to have insurance for the property, even if you're going to hold it for 3 months, because you don't want to have any issues. And sorry about that. And so on and so on. So uh, real estate investors are familiar with this. They have a closing cost section, and then automatically they have a carrying or holding cost timing, right? All of this is where all the money goes out. All the money goes out here. There's no money coming in because you still own it. You haven't sold it yet, right? You're buying
Correct.
something and you're holding it and you're putting money into it. You're putting capital improvement. You're putting all of that. You cannot expense all of this until you sell it. So let's
Mhm.
say 3 months passes and you have like I don't know, $300,000 in expenses and all of this. All of that gets transferred when you sell it to the profit and loss to basically exactly the same categories, but now they're expensed. You see here is the same categories: closing cost, carrying cost, and in top of that, now you have sales cost. Now you're selling, you have to pay the real estate commission, I don't know, transaction card, you have to pay another title fee, depending if appraiser, whatever you pay when you sell it. So the combination of these sections here is going to be your real expense.
Mhm.
You transferred it from your inventory to your profit and loss. Now you can expense it because up here, you're going to have real estate flip and wholesale. You're going to have property sale. So you're going to have $500,000 income and $350,000 expenses type of
Yeah.
thing. I'm sorry, I tend to go too detailed. Let me know if I'm making sense for you.
Yeah, it's making sense.
Okay. So that is very important to know that, because I've had clients that say, wait a second, what do you mean I can't deduct it? I just spent $200,000 buying a property. I'm like, yeah, but that's inventory. It's going to stay in your books until you sell it. And they're like, you can't expense it, and you can't. There's some stuff you can expense. You can expense the marketing, salary, professional fees, office bill. You can expense all the generic or general expenses that you.
Oh, so just the purchase price, you can't expense it yet until you sell it, if that was your plan, is you're a flipper, you're a dealer.
Uh,
But everything related to it, like the marketing, and because those can get pretty expensive, like we were talking about before.
exactly. Exactly. Yeah, especially marketing. Check this out. I mean, I started making my master chart of accounts based on the typical expenses that real estate flip investors have. And is tip marketing and advertising, and under here we can have like 10 little line items, because they have everything. They have pay-per-click, ring voicemail, social media, text messaging, TV, radio, website, cold calling. That is very expensive,
Barry, tell me
right?
about it.
So if you don't keep track of this in order to compare it to how much you're making per property, that's when at the end of the year you can say, hey, wait, what's going on? I made so much money selling the properties. but you also had a lot of expenses. You need to keep track of that. So
These are great categories. We're going to break it down on the next video too.
yeah.
We're going to go through all of that. That's great. So, so have we covered the ways to maximize the tax deductions related to real estate investments then, right?
Yes, I mean, every case would be different. The thing with tax deductions, Sandra, is the following. When you want to maximize tax deductions, I would have to start asking you, okay, are you married? What are your goals? Do you have kids? How old are they? Do they want to go to the university? Are you planning on investing for, there's so much stuff. How old are you? What's your plan in the next 5, 10 years? Because all of that takes into account. If you're in your 70s or 75 and they tell you, oh yeah, put money into retirement, you're going to be like, oh, I don't know. Seriously? I mean, I'm already getting money from my retirement. But if you have kids, there's also tax strategies, to hire your kids, get them to work, start making them earn their money, and you save tons of money in taxes when you do that, because of course they're going to be at a lower category in tax rate than you are. So if you have married, you have a wife, and you need health insurance, or you have health issues. If you have health issues, you might want to use another type of view of things. Then you know what? I'm going to hire you, and all I'm going to pay you is health insurance, and we'll deduct the complete thing about it. So, the tax thing is like, it cannot be general, because every single person. When my kids were smaller, I left my company as an LLC for a few years. They worked on the summers, and I took more advantages having my entity one way. Then when they turn 18 and 21, okay, forget it. Now I'm going to change it to my other way, because they don't take as much advantage. My wife works as an employee, so I couldn't do the other advantages with her, but somebody that their wife works with them, they can work something out. So every tax is different, but that's why it's so hard for me to say. And I don't like to.
Tell me what some of the traps are for investors when they employ their kids. They call you and they say, "Yeah, I want to put my kids on there just to save money."
The trap is when
Yeah.
they only do it to save money. So I actually had not a blog, but I went in a forum and with the other CPAs, and I was like, do a lot of you get this type of thing where the client is like, oh yeah, I'm gonna put my 3 kids making 12,000 and change, because that's the exact amount of the standard deduction. That's how much they can. I was like, okay, are they working? If they're not working, then that is a trap, because you are
Bingo.
basically, you you want to do it right. If you have and I didn't hire my kids when they were five
So
or
that
six.
means they actually have to be doing something.
Yeah,
Just like if you would hire a stranger, you wouldn't just
yeah.
pay them to not do anything.
Of course, yeah. You can find something that your kids at 12, 13-year old can do. I mean, they're great in computers. They can archive. They can help you. Look, both of my kids, when we did rehabs and we did flips, both of my kids went on the weekend to put floors and to paint and to do all of that. And I'm not making this up. As a matter of fact, the house that I have right now, they help me every time I do something. They're involved. I can't deduct that, but I'm just making a point that your kids can help you, especially in a flip business. They can do the demolition part. They'll love that. Give them a
Oh
hammer.
yeah.
They'll love to, knock some walls out and everything. So
All right, cool. Give them a little hard hat. You mentioned archiving too. So what are some of the records and documentation do investors or agents need to keep for tax purposes, and how do you organize them?
okay,
Probably
this
going to go towards some of that spreadsheet that you have with the chart of accounts, but let's keep it a little bit more simpler to begin with as far as what the documentation are in the software, because we're going to do the whole spreadsheet in a different video.
what I ask from my clients most of the time is, they don't have to really get too concerned with where it's going to go, because that's my job. They just need to be willing to tell me what it was used for, specific things, right? So let's say you're a real estate agent. I know that when I see your bank statement, I'm going to see Supra billing. That's part of your real estate, the electronic key expense type of thing. When I see Aura or MLS, I know that that's your annual renewal. When I see training, I'm going to know probably about 80 to 90% of the things that are going to be in your bank statement and your bank transactions. So I'm going to organize it, and we'll deal with that with the chart of accounts, et cetera, in the next video. But I'm going to organize it in a way that when you read it, it's going to make sense to you. Oh, yeah, that's right. I went to Aura that month, and that's why this happened. But also, the percentage of the expense that goes against the income is very important. That's why organization is so important, whether you have a real estate agent, a real estate investor, etc. So the short or the basic answer is I get the information from your financial state institutions, your bank, your credit card, your loans, etc. I get the information. Like my clients give me access to get into their bank account or their credit card account or their Square account or whatever account the money comes in, goes out. I get access. By the way, the access is real only. It's for accountants' use. I can't make transfers or anything like that. So I download all of that and I analyze every transaction and I put it in the correct place. If I don't know anything, I call it a suspense account. And then I can go, hey, Sandra, I noticed you spent so much money in this vendor or this company. What was that for? And you can tell me, oh, it was for ABC. And then I categorize it depending on the usage that you gave that expense. That's why it's so important to not only to be in compliance. I don't want to say I don't care. I mean, that's fine. You have to be in compliance. You have to do the taxes, all that stuff. My goal is for you to be able to analyze to say, hey, you know what? I'm spending too much in this. I'm paying this person too much. He's making more than I am, and he's your employee. Those analyses, it might sound weird, but it happens. If you want to test that what I'm telling you is true, go to your personal transactions and get a list of everything you bought in Amazon. Most
I
people,
don't think I want to see that.
yeah, most people when they break it down per month, they go like, holy smoke, because they don't analyze it. The money goes in the bank, they spend it, and as long as there's money in the bank, but in business, you can't afford to do that. In business, you need to know where your money is going. 99% of the time, people don't know where their money is actually going. So anyhow, I can talk forever about that subject.
All right, and then one of the last questions I think in this area is in this video, because we're getting long, don't want to
Mhm.
be too long. It's a pain to upload when it gets
Yeah.
long. What are some of the potential tax traps and pitfalls you should be aware of
Tax,
in
taxes.
real estate? Yeah,
Taxes is always the number one thing, right?
it's
Tax.
probably a lot. If maybe you do like the top three or something.
Okay, I'm gonna give you the top three things that is my annual headache when I deal with taxes. Mileage. Mileage is my number one. According to the IRS, if you want to be technical, you have to have date, reason, and mileage, right? They don't give you a specific form or anything. There's apps on the phones, Mile IQ and things like that. But if you don't use it, then at the end of the year, you're gonna have a hard time. So they always say, if you don't keep track of it, if you get audited, there's a chance that they can deny that deduction. So mileage is important, very important for two things. Number one, it's a lot of deductions, especially for real estate investors. They're always going from one place to the other. They're not like in Zoom all day meeting people. They're in the house checking the rehabbers. Real estate agents. My God, they drive all day long. You can't Zoom show houses. You have to go in person. So keep keep track of your mileage. Just get the app, swipe right, swipe left, swipe right. I'm serious. You swipe right is business, swipe left is personal. Every time you get in the car,
Cap is that
Mile IQ,
Mile IQ. Okay.
and then at the end of the year, at least you'll have a record, right, of what it is. That's one of the main things. Number two, when you have an S corporation, you have an S corporation, right?
Yes.
Or you have an LLC that is taxed as an S corporation, probably.
Yes. Yeah.
Okay. So do you pay yourself a salary?
Yes.
Okay. So you are in payroll. A lot of times people open up an S corp. Number one, they open up an LLC, they make it an S corp. They don't know why. They just did it because whoever opened up the company told them to open to make it an S corp, but they have no idea why. So when they come to me and I tell them, send me your payroll report, they're like, what do you mean? I'm the owner. I don't have any payroll. That's a no-no. Okay, that's a no. That's one of the. It's an easy red flag for the IRS to know if you're not paying yourself salary or reasonable salary, just by looking at the first box of the tax return and say zero. Who is doing the work here? You can't have zero in salary or payroll. Somebody has to be doing the work, right? Everything can't be distribution. So payroll is a big one. Okay, so you have to do payroll, and payroll you have to report either monthly or quarterly, depending on how much you make, and it has to be done because if not, the state is a biggest pain in the behind than the IRS. They'll
Yes,
come
they
after.
have penalties too.
That's number two, and number three, the biggest thing. Well, actually, I'm glad you asked that question. The biggest thing out of all of them is that most small businesses mix their personal and their business transactions in the same bank account. Okay. And that is just wrong to begin with, but it also opens them up to liability. Because if you have a business, it should be only used for business, and then your personal for your personal. So when you have your business and you start paying your personal stuff with your business, it's not that you're deducting more money, because if you are my client and you tell me you paid for the soccer field trip for your daughter, in another state, and you spend 3,000, I'm not going to deduct it. I'm not going to go ahead and expense it. I'm going to call it a distribution to you. So you're not taking any tax advantage whatsoever just because you paid it with a business card. But you can open yourself to liability. I heard a lot of attorneys say that when you do that, you pierce the veil. That's their terminology.
Yeah, pierce the corporate veil.
Pierce the corporate veil. And so why do it? So if you have the $3,000, transfer it to your personal, okay, with your personal. And if you're always tight, then every week do smaller amounts and transfer them to your personal account and have your business separate. That is extremely, extremely important. Number one, it keeps the books cleaner, but number two, it also protects you. So mileage, payroll, and personal and business, I think, are three main categories that I think would help a lot of people that are watching this that are just starting.
What if it's someone that doesn't have a company set up and they just are doing things in their own name? You had a great suggestion for that when I talked to you the other
Open
day.
another personal bank account. As simple as that. As simple as that. And that every time I get a call and they tell me that they only use their personal bank account, I tell them, go to the bank account, open the new account, and then call me to see how serious they are that they want to treat their business as business. And I'm not trying to be, arrogant or anything. Is that why would you put all your business money in your personal account? It just doesn't make any sense. By the way, I am starting to recommend, I don't get any money or anything. There's a bank called Relay. I don't know if you heard about it. Relay Bank.
No.
It's free. You don't have to have a minimum amount of money or anything.
How do you spell that?
Relay.
Okay, Relay Bank.
I think is that.
Are they like a brick and mortar or just an online bank?
No, it's online.
I've heard
Actually,
of them.
that actually they're not the bank. They are the technology that works with the bank to provide this. But the reason I'm starting to recommend them more now than before, yeah, Relay Financial, is because since they don't charge you, like if you go to any of these brick and mortars and you have less than $500, they charge you $20 a month. You have to have
Yes.
more than an amount, et cetera, et cetera. This bank, let's call it a bank for now. This bank allows you to have, I don't know if it's 10 accounts with no minimum balance, right? So, and we can do another video about that. But one of the things about knowing where your money is, I'll just tell you a little bit of what I like to recommend. You have your main bank account, all the money goes in there, right? And to simplify this a lot, you open another bank account and you say for taxes, right? You have another bank account. And every month you throw a little bit of what your accountant, your tax preparer tells you that you're going to owe. So that way, when you pay taxes, you don't have to go into your real money, you go into your tax money. Because what happens a lot of time, you have money, you see money in the bank, you see money in the bank, you go to vacation, you spend it on a cruise, you go out to eat and then your tax preparer say, hey, remember to send the quarterly estimated tax payments. You need to send $4,000. And you're like, what? I don't have $4,000. You already spent it. So now you start owing, right? But every month you start putting a little bit set aside. And then at the end of the quarter, you grab it from that account. It doesn't affect your lifestyle. It doesn't affect it might sound simple. A lot of people are reluctant to understand the idea. But once you get used to it,
That's a good idea. And that way you don't have a debit card or anything that you can accidentally use that money for anyway. You're just only using it for your taxes. So you can have a separate account for just throwing in some money every month for your taxes, and then a separate account for just the business expenses, a personal account, but just a secondary, an additional personal account if you haven't set up your company yet, just so that you can make it easier to separate your business expenses from your
oh yeah.
own personal expenses.
And you know what? Now that we're talking about it, you know who uses this method a lot, or who should be using it? Real estate people that flip. And the reason is that if you have all the money for rehab in one account, that's why they don't know where their money is going. How are you going to know if you have everything in one account, how much is allocated to property one, property two, property three, or property four? You would have to have Excel spreadsheet and continuously check it. So, and this is the last time I'm sharing because yeah, I know it's getting long, but this is actually exciting for me. Check this out. This is my balance sheet, right? You see this account here that is called rehab and lenders.
Mm-hmm.
Okay, this is a bank account that I normally go ahead and break it down into other sub accounts only in QuickBooks, right? So what I do is that you get all the money here, right? And then you say, hey, we're going to use 30,000 for property one and 50,000 for property two. I transfer from here to here, and I put 30 here and 50 here, for example. So that way you know that when this is going close to zero, something is wrong with your rehab budget. If you leave it here, you'll be using Peter's money to pay for Paul's expense.
I see.
You get it? So I think this is a very good technique to keep track. And more than that, when you have other people's money, that this is like when it's your money, right? But if you have other people's money, you want to be even more
Yes.
detailed. You see?
For example, when we do joint ventures, we're using other people's money to purchase properties, and we always keep them in a separate account because you don't want to accidentally dip into that money and then you need it for something and it's not there.
Yes. And what happens in Excel, it helps you, right? But if you have it in the bank account, let's say this bank account has $10, just to make it dramatic. And this account has 30,000 and this account has 50. You know that when this one is going low, it has to do with this property. And when this one is going low, it's going to do with this property. If you have the $80,000 here, you could easily spend 60 for one, and then you don't even have the 30 for the other. Because it's very hard to keep track when you have everything in the same bucket.
Just looking at this right now makes you sleep better at night, knowing that you have it organized and there won't be no oops moments sitting there with your head on the pillow wondering, oh my gosh, have I checked to see how much I've been spending so far? No, that's great.
Yeah. This is, I mean, it really is. It seems like, oh, why so many bank accounts? And, you have to keep track. But you see income tax right there. You see, you know how many times I asked my real estate investor clients, so how much are you paying yourself? And they're like, I have no idea. I just take money out when I need it. That's a no-no. Pay yourself first, and then
I'm laughing because I sometimes do that too.
yeah, you need to have something set aside for you. That way you know where you need to make the changes.
We just
Uh,
want to keep it all in the business. We know, hey, the business needs to have money. I just take out the minimum that I need.
Yeah, no, it happens more, and I don't know. It's I love this. I love letting people know that there is a way that they can keep track of things.
Juan, what are you
What?
showing those bank accounts? Those are all separate bank accounts, or is that using the relay thing that you told us about?
It's still separate bank accounts. It's relay, but you can say main account, income tax
So if we
account.
don't have much money in those accounts, they're going to charge us fees.
No, not in relay.
Not in relay.
No,
So we
there's
can relay allows us to separate. So
yeah,
relay is not a bank, it's something that's used within the banks. So it's to like segregate your money.
yeah. I can't remember the name of the bank, but relay works with a bank. There's a bank. There's a FDIC approved, and they have the guarantee for 200, 250,000, etc. It's like a regular bank, but not to confuse the clients, relay
Yeah.
bank, and then
We'll
they
put
can
the
do the
link
research.
too so they can look into it and find stuff about it out now. I said that was going to be one of my last questions, but I realized I didn't talk about the home office deduction because a lot of people are working from home right now.
Okay.
And how do people do it right or wrong?
I I I think I think everybody should be working from home, even if you have an office. And Alex, let me not go back into my whiteboard. I'm a whiteboard person, and I talk with my hands a lot.
Hmm.
So this is the thing. No matter if you own your business, right? The deduction you're going to get from your home office is not a big deal. It's really not. I mean, you can't see my room here, but this is my office. I don't know, 10 by 10, 10 by 12. And in compared to my house, it's not a big deal because the home office works the following. If you have a space where you do administrative work and you work for your company in that space and you only use it for that, then you are allowed to take home office expense, right? Now, if you have a 3,000 square foot house and you're using 100 square foot for office, what is it? I don't know, is a percentage, is like less than 5% of the complete house, right? Is going to be expense. So if you spend $10,000 in your house or $20,000 in your house or $30,000 in your house, you're only going to be doing a couple $1,000 in expense. So that's not where the biggest advantage, in my opinion, is. The biggest advantage of having a home office is that for tax purposes, as soon as you get in your car and you drive, it's considered mileage, right? So this tends to be a little confusing. Let's say you don't have a home office. Right now, you don't have a home office. You get in your car, the first stop you do when you're going to work or going to do anything related with work is not considered mileage. So if you go visit your first client 30 miles away, that first 30 miles, you can't deduct it, or you shouldn't. Nobody cares and everybody deducts it, but I'm telling you the rule, right? The rule is that you go from your first place of business. That's when you start deducting. So in home office, since your home is your office, as soon as you get in your car and you drive, that's it. You can start deducting from mile zero, basically. If you don't and you have to drive to real estate agents are a perfect example. They go from their house to the real estate agent broker, right? I tell them, hey, you know what? Go into your house, get a room, make it your home office. That way, that 10 miles, and in Orlando, is like everything is like freaking 25 miles. Nothing is 10 miles. Those first 25 miles you can deduct. If not, technically speaking, you cannot deduct it. So you're losing 50 miles a day. You can deduct everything from your what you might call it, your broker's office. Everywhere you go, you deduct. But then from your broker back to your house, you shouldn't. That is the technical IRS rule portion of it. And most people, did you know that, by the way? Because most people don't.
No, no, I didn't know that.
Yeah, most people think the home office, oh yeah, I'm gonna deduct the electricity, the water, the rent. That's true, but only in the percentage that you have your office. That's I mean, if you have a 20 by 20 or a 30 by 30 office in a 1,500 square foot house, then yeah, you're gonna deduct 60, 70% of your expenses. But normally the case is one room out of the house. You don't get that much deduction anyway. But it's
So you're
okay.
saying the main benefit is the mileage because you're going from your home office to wherever you're going. So then you're not factoring a percentage of the electric.
You are.
You are, okay, and the internet and things like that.
Yeah,
Okay,
you
that.
still do that. You still do that. I mean, you still deduct anything, and it's completely legit. I hear some CPAs like they don't like it, or I don't know why not. I mean, it's completely legit,
Okay.
unless the person does not have a home office and they work from their bed with their laptop in their lap,
Hmm.
and then they're considering their room their home office. I mean, those are, pushing it type of thing. But if you have a space where you sit down with your computer and you open it up and you read it, why not? I mean, it's completely legit. You're using a space of your house for business. There's nothing wrong with that. And the typical expenses are rent. If you don't own the house, you can deduct a portion of the rent, utilities, anything that you pay related with the house. And if you do something in the office, you can deduct it 100%. So if I add, oh, you can't see it because I have the background, but my fan, if I buy a fan for my office, it's 100% deductible. But if I fix the air conditioning, it's a percentage because that was for the whole house.
Okay, okay. That's a really great idea. My home office actually does need the fan replaced. That's ironic. I'm gonna make sure that's gonna
Yeah,
be.
and the cleaning people just, tell them to do a better job in the office and you pay more for the. I'm just kidding.
Oh, that's right. Yes, the cleaning. Yes, yes,
They'll give
absolutely.
you two invoices, one for the office and be nice on the
Is
house.
that how you would do it? Yes, they would have to give you two invoices, one
No,
for the no, you can just
no.
separate it directly
If
yourself.
you do everything
Okay.
properly, yeah, don't complicate your life. I'm just exaggerating. But if you do your flooring, you change your floor, you paint your office, those type of things could be 100%. Anything that is only for the office, 100% deductible. Everything is for the whole house, is the percentage. Like if your home office is 10 by 10, that's 100 square feet. And if your house is 1,000 square feet, then you have 10%. If your house is 2,000 square feet, then you have 5%. So out
And
of
you're
everything,
finding that out by getting a measuring tape or whatever app you're using to measure the room
yeah,
and factoring that in as a percentage of the house's total
yeah.
square footage.
And I'm a little aggressive on this because I have some clients that use their garage, and there's a little bit of a back and forth on that end. But I actually went to one of my clients' house and I opened his garage, and all he had was work-related things in there. So I'm willing to go bad for him, saying, "Hey, you know what? It is used. I'm not going to be afraid of deducting something extra because the garage is like 20 by 20." And he was only using it for business. So, it, look, the IRS is a Boy Scout method. The IRS is going to believe whatever you tell them. If you tell them the truth and it's reasonable, there's no reason to be afraid of them. If you
Hmm.
want to exaggerate stuff and push the envelope to the point where it becomes unreasonable, then that's when you get in trouble. But that's that's kind of how I see it.
Wow, Juan, we went through some really amazing, great stuff so far. I think we're ready to move on to the next section, unless there's something you think that we missed. We're going to go on to the next video.
No, I'm good. Thank you very much, and I'll stop this one, and I'll call you, and we'll see how we do the next video.
All right, perfect.
All right, thanks.